Welcome to Market Catalysts. I'm Julie Hyman, and we are 30 minutes into the U.S. trading day. Here's what we're watching. First up, stocks extending gains on the back of a strong jobs report. We'll break down what that means for the Federal Reserve. Plus, Walmart boosted sales outlook amid a resilient consumer. We'll talk to the CFO of Walmart, John David Rainey, to discuss. And Nvidia shares pop after a blowout earnings report. We'll break down the results and what that means for the AI trade. Taking a look at the major averages here, we are seeing an extension of gains throughout the morning. Strong trading here. The Dow is higher by more than 650 points. That's a gain of about 1.4%. The S&P 500 up by 1.9%. And the NASDAQ Composite is gaining 2.5% today. So a lot of different ingredients in the mix here today. There are mainly three that are the strongest. One, a jobs report coming in for September that was better than estimated, even with a revision lower for August that showed a drop in jobs in August. It's being read as relatively positive. Secondly, Nvidia coming out and once again beating estimates and sounding a very bullish tone. And then Walmart as well, raising its forecast for the second time. So all of that equaling stocks higher. We've also been watching the bond market closely on the back of the jobs report. There we're seeing a little bit of a decrease in yields here. Still some debate about what could happen in December and whether the Fed is going to cut rates. And then elsewhere, I'm interested to see that Bitcoin is trading lower, because the perception is that a rate cut would be good for Bitcoin. So what does that tell us? What's the read through here for what that means about what's going to happen with rates? And then individually looking at stocks here, of course, you got to start with Nvidia. Nvidia shares up about 4.5% here. If you look at what Nvidia shares had been doing since the end of the third quarter here, of course, we saw this gain, but then a come down. So some selling, of course, going into today's numbers on the concerns about return on investment or concerns about valuation surrounding AI. But almost everything AI is up today. Alphabet shares up 4%, Broadcom shares up 5.5%, Meta is gaining. And you see that really many days here, the NASDAQ 100 is up just on the strength of the largest cap tech. But you see here, it's a pretty broad-based rally within the NASDAQ 100. And if you look at the sectors within the S&P 500, that's also the case. All of the sectors of the S&P are higher today. There are two that are doing the best, consumer discretionary and tech. But nonetheless, it is a relatively broad-based rally that we are watching today. And I'm going to try and scooch on over here and see if we can find the retail board to see if we can take a look at. There it is. See if we can take a look at what's going on with Walmart. There it is. Walmart shares are trading higher by 6% on the day here on the back of those strong numbers. They've been wavering a little bit in pre-market trading, but now pretty solidly in the green, and we are seeing other retail broadly get a lift as well. Let's get back to Nvidia. Nvidia reassuring investors with strong results for its third quarter, re-upping its forecast for revenue for its Blackwell and Rubin chip lines will be in excess of $500 billion through 2026. For a deeper dive into Nvidia and what's the next major development for the AI trade, Patrick Moorhead, More Insights and Strategy founder, CEO, and chief analyst, is joining me now. Pat, it's great to see you. So Nvidia coming out. I actually want to start here. Is there anything that Nvidia said that surprised you?
The short answer is no. And what they did is they went right after the bears on demand, on financing, on depreciation. And you know what we saw in this round was we didn't hear the chatter of execution that had, I wouldn't say plagued, but had put some doubt into the system on whether they could execute on the current quarter. I was surprised that Jensen and Colette went right after it, and I think the investors appreciated that.
Yeah, they definitely seem to. If you're looking not just Nvidia, but at the rest of the space here this morning, I mean, I feel like with Nvidia, the halo lasts a while from what they've said on the earnings report, and then the attention quickly goes to, okay, what's next, right? What's the next gain? What's the next order cycle look like? So how should investors be thinking through that, especially given that the forecast is strong?
Yeah. So first of all, the clarity around the $500 billion, 5 to 6 quarters, I think was really good. It's a blend of Blackwell and the next generation Rubin and Vera Rubin, and that should give people a lot of confidence. And then I think we're going to get to Interestingly enough, I think there's very little risk for 2026 moving forward. The demand's going to be there, and we can debate on whether that's frontier model development and inference or something different. But 26 is pretty certain as well. But as we get into 2027, what we're researching is the amount of power to drive these new hyperscaler data centers out there. There's just not enough power. And a lot of people are being creative around it, but I don't have the definitive answer. And I think the age-old downstream demand will come back. The who's using this other than these companies like an OpenAI or even an Anthropic. And I think that will come back into focus. But I'm as confident about 2026 as ever. Certainly, there could be execution challenges on Rubin and Vera Rubin, but the company really is hitting on all cylinders. And people forget Jensen took the roadmap from 3 years to 2 years to 1 year, and even a midlife kicker in there for higher performance.
Higher performance, and what about on the energy side? I guess I have a two-part question. One, do you think at some point that lack of energy and the end, in the data centers, can constrain orders for NVIDIA chips? And secondly, what's the opportunity here for NVIDIA to make a more energy efficient chip and that be part of the solution?
Great question. First off, I feel comfortable with 2026, the build outs, the amount of gigawatts, and the current production, even on power generation from natural gas. Almost 40% of the build outs are in my great state of Texas, and it's simple. We have a lot of energy in the ground that you can take out and create energy, and you put batteries up there, and you're not putting that cost to the direct consumer, as opposed to West Coast and East Coast that basically they're saying we don't have enough power, and the people who live there don't want to raise the cost of energy, which is completely understanding. NVIDIA did actually announce, not with a ton of fanfare, a chip that's Blackwell related that splits up the AI task that requires less energy for things like inference down the road. And I do believe that if these, I call them XPUs, these are non-GPU accelerators, if they get a hold more than they are today, where they're being used at Microsoft, at Google, and Amazon and Meta, I think you will absolutely see NVIDIA put out more of an accelerator type design into the future.
And is there sort of a technological ceiling for what NVIDIA, for the advancement of these chips? I mean, as you said, the speed has been compressed with which they're coming out with these new innovations. So what's the end game there look like? And will the market even want it to go past it or need it to go past a certain point?
Yeah. Yeah. So Julie, we've gone from the chip to the board, to a tray, to the rack, to multiple racks next to each other. What's happening now is data centers are being connected with super high speed links. So multiple data centers can act like one rack of GPUs. Chinese did it first because they needed the scalability because their chips were lower performance. And then we've seen Meta and Microsoft recently did an announcement talking about how these are all put together. You have Stargate build outs where they're putting the data centers right next to each other. So multiple data centers can act like a single fungible unit. And Julie, on the where does this go? I hate to throw out the AGI term, but when we get to AGI, that's generalized knowledge, then I think things start to slow down from a massive data center standpoint. But you know what cooks are the things that aren't being hit, this physical AI and robotics. Amazon is the largest keeper of robots. They have 1 million. And even they talked about downsizing 75% of their people. I wouldn't be surprised if we see 5 million Amazon robots in 3 to 5 years. And the Chinese are well ahead. For every robot we develop in the United States, the Chinese are developing 10. So yeah, maybe once we get to AGI in the large data centers, we will also be building out this massive AI opportunity in what Jensen calls physical AI.
Wow. Well, that makes a lot more sense to me than having a robot in my house in the next 5 years. But, and finally, though, what about competition for NVIDIA, right? We haven't talked as much about that lately. It's kind of receded. But, like, AMD is still there. Broadcom is still there. Not only are they there, Amazon is, you know what I mean? The hyperscalers are making their own chips, too.
Yeah, they are. And if you look at OpenAI and Anthropic, right, they're doing bake-offs as they should, right? They're doing deals with everybody, and I think they'll look at the TCO, which one's working on the best. All things considered, an XPU is cheaper and is much more energy efficient. The trade-off is it typically can't run multiple generations of AI like a GPU from AMD or Nvidia can do. And we're modeling right now that within 2 years, right, Nvidia will still have 70% of the market, but 30% of the market will be split between AMD and the XPU makers, ultimately Broadcom and Marvell.
Pat, great to see you. Thank you very much.
Thanks, Julie.
Coming up, Walmart CFO John David Rainey will join us live after the company topped third quarter expectations and announced plans to move its listing to the NASDAQ. What he sees as well heading into the holiday season, all of that is next on Market Catalysts. Walmart lifting its full-year profit outlook after topping third quarter expectations, getting a boost from consumers looking for value. Joining me now, John David Rainey, Walmart CFO, and Yahoo Finance Executive Editor Brian Sozzi, tag team in this one with me. John David, good to see you. Thank you very much for joining us. Very festive scene there behind you. Talk to me about the quarter and what you saw as the sort of primary drivers of the earnings beat and the sales strength that you guys saw.
Well, we're certainly seeing that customers are looking for value. They're looking for that convenience that they've come to know and expect, and are looking for companies to do business with companies that are executing consistently well. We continued to gain share in the quarter, and we were really pleased. You see the continued momentum in our business. We grew the top line 6%, grew profits faster than that at 8%. And I think a shining point for us in the quarter was once again our e-commerce business. Each of our three segments grew more than 20%, and overall as an enterprise, it grew 27%.
John David, look, Walmart, we've talked about this in the past. Walmart is America. It is that average household. As you zoom out on this quarter, is the average household in this country experiencing an affordability crisis?
It still feels very consistent to us versus prior quarters. But what I will say, Brian, is if you dissect that a little bit and you look by income cohort, the disparity between the low income cohort and the upper income cohort has grown a little bit in more recent months. It's consistent with the macro data that you all see. Like if you look at October wage growth, the difference between wage growth in the low income and high income cohorts was as large as it's been in almost a decade. We see a little bit of that in our stores. So it's something we're keeping an eye on. But overall, when you take the consumer in total, it still feels very consistent. And if you look at our guidance for the fourth quarter, it's pretty much like what we've experienced already this year.
When will prices on food begin to fall? I'm sure you've been tracking the news. The administration is trying to bring down the prices of coffee, in part because coffee prices are higher because of tariffs. Like, when does the household see things get a little cheaper?
Yeah. To start with, I think you need to step back and think about the overall price level of food versus maybe 5 years ago. And food prices are still 25% higher than they were during the COVID time period. In the most recent quarter, like-for-like inflation for us was about 1%. We're actually really encouraged by some of the new announcements from the administration where they're going to take tariffs off some of these items that we're solely dependent upon with sourcing from foreign countries. Things like avocados, bananas. we can't grow those at scale in the United States. And so bringing the tariffs off of those should provide some relief for consumers as we go into the fourth quarter.
And John David, what among those types of items, are there certain ones when you see the price come down that it sort of drives traffic in the store, that you view them as a sort of lost leader that people get excited about? Or, I don't know if eggs are in that category. I don't know if coffee is in that sort of a category. But are those items that you can think of that would fall into that?
Well, let me give you an example. Behind me, we have a 50-inch Vizio TV. We're selling that for $128. And I want to pause here. We saw someone in one of our stores the other day that had 3 of these in his basket, and we asked him about it. And it was priced so low that he thought we had made a mistake and mispriced it and was taking advantage of it to buy 3 of them. But when you see something like that, it's telling you that customers are willing to lean in and buy those higher ticket prices when they find value with them. But how that translates into our financial results, you'll remember we bought Vizio. With Vizio, we control the operating system, and so we have that relationship with the customer far beyond that specific moment of the purchase of a TV. And so the margin on selling a unit of a TV is not that great, but we can monetize advertising by providing that additional channel to them going forward and continuing that relationship with the customer.
I was going to say, I'm sure you can't make a lot of money on a $120 Vizio TV, but it must have other uses. So does that also, not just you getting the revenue from the lifetime of that product, but does that also drive traffic into the store, and then you keep them in with some of these other value propositions that you're offering?
It absolutely does. And what our team has done a really good job of this year is what we call mixing out the basket. And so it's trying to minimize the overall price impact or cost impact on customers by being very selective about where we price maybe higher tariffs, pass those on to customers, versus where we might absorb some of that cost impact. And so again, if you look to the most recent quarter, inflation was only up 1%. And so it shows you that the team has done a good job of mixing out the basket to minimize the impact on the consumer.
John David, early in the week, I caught up with the Target team, and I thought they were going to boot me off their media call when I asked them this. I asked them point blank, are prices just going to stay high for general merchandise for as long as tariffs are in place? Then they tap danced around it. I mean, that's what Target does. I'll put the same question to you. As long as these tariffs are still in place, do consumers just need to be accepting that prices for things that maybe were cheaper a couple years ago they're just going to be higher? You have to deal with it.
We're wired for everyday low prices. So, we want to find every opportunity to try to bring down prices for customers. I'll give you an example. It's not general merchandise, but a basket of items for a Thanksgiving meal, we can price for 10 people at $40. That's less than it was a year ago. And so we're always looking for these areas where we can try to bring prices down. And as the example with the TV, when you have these really attractive price points, it will drive store traffic. It will create a reason for people to come into the stores, and they don't just buy the TV, they buy other items as well. And so we're working really hard on behalf of our members and customers to bring those prices down. But tariffs have been something that we've had to absorb some of. It's been something that has caused higher cost of goods sold for us year over year, but we're working hard to bring the prices down.
We have this debate a lot here at Yahoo Finance, John David. Why is Walmart just demolishing Target? Now, you may not mention even their name, Target, but every single quarter for the past 2 years, I mean, I know you have to study this competitive data. What are you doing that a company like that is just not doing?
Well, let me just speak to what we're doing at Walmart, and you can be the judge of how well others do this. But Brian, I think there's historically this notion that maybe there's a trade-off between value and convenience. And I think at Walmart, that's a bit of a false choice. We can provide both of those, and we're demonstrating that. That's one of the reasons that we're gaining so much share. So if you think about, we've characterized the consumer over the last couple of quarters as value-seeking or choiceful. It stands to reason if times are getting more difficult or budgets are being strained more, you're only going to become more choiceful, more value-seeking. And so customers we see are looking to do business with companies that provide that value, that give them the convenience that they've come to know and expect, and that are consistently executing well.
John David, I want to ask you about hiring. You guys are the nation's largest employer. We just got a jobs report this morning that showed numbers were a little bit better in September than economists anticipated. October's a black box. We don't know. We never will know because the government's not going to come out with the numbers. But there is, as you know, a lot of trepidation out there. What are your plans, or I guess you've already hired for the holiday season most likely. What did that hiring look like, and what does your hiring cadence overall look like given this backdrop?
Yeah, well, we still have almost 5,000 stores in the United States, a similar number internationally. And so we're very dependent upon people to run those stores. When we look at sort of the cadence of hiring over the last couple of months, like we have 2.1 million associates overall. And so we're going to continue to be a people-led, tech-powered company and rely on the humanity of Walmart and the humanity of our people to serve our customers in the very best way that we can.
Can you give us a number as to how many folks you've hired for the holiday season?
I don't have a number. We certainly, as we go into the seasonal period, we always have a bit of a ramp up to make sure that we can serve our customers and the additional traffic in our stores, but we're going to continue to hire going forward. I know there's been a lot of talk about AI and how that's going to change jobs, and I think it's certainly reasonable to assume that it's going to influence or impact jobs, many jobs. Some jobs may go away, some jobs may be created, but what we're trying to do at Walmart is use AI as an and, not an or, where we can put AI and technology in the hands of our associates to better serve our customers and make their jobs easier.
John David, if I've learned anything about covering Walmart, maybe close to 20 years, believe it or not, is that when Walmart does key things, they tend to do it early and others will follow. Now, you're changing your listing from the New York Stock Exchange to NASDAQ. Now, I know you don't take that lightly. I mean, what's the signal you were trying to send investors about your next decade by making a move like that?
There are many factors that are considered when looking at where we're going to list, the trading execution, the brand associated, the inclusion in the index of the NASDAQ 100. When we assess those factors and we look at what's best for Walmart, we think NASDAQ better fits with the next chapter of Walmart, being people-led, tech-powered, and being associated with innovation. We view ourselves as not only a disciplined executor, but an innovation leader, and that's very much associated with the NASDAQ brand.
Lastly, John David, you're going to have a new CEO soon. Doug McMillon, longtime Walmart CEO, is, of course, stepping aside. John Furner, who has led the U.S. business, getting that position. When do transitions like this begin in the case of Walmart? And, you know, out of the block with him next year, like, where do you think his focus points will be?
Yeah, well, we're all very sad to see Doug go. He is a leader of leaders. He's done remarkable things for Walmart. But at the same time, we're super excited about this next chapter with John. So many of the improvements that we've made as a company over the last 5 years, particularly if you think about e-commerce, John has his fingerprints all over. And so we take a very long-term perspective when we think about leadership changes like this. And this has been a very planned and thoughtful transition. It begins to take place, though, day one. You can certainly see that there are areas where Doug takes a step back and wants John to come in and make the decisions. But we think this will be a smooth transition, and we're all looking forward to it.
John David, thank you so much for joining us and taking the time this morning, and thanks to our Brian Sozzi as well. Thank you.
My pleasure. Thank you.
At Yahoo Finance Invest, I got the chance to sit down with Robert Smith. He's the founder, chairman, and CEO of Vista Equity Partners. We talked about how artificial intelligence is transforming the economy and his portfolio companies.
What we are finding is a massive amount of productivity that comes, not surprisingly, from all aspects of what this technology distributes off the infrastructure that we are managing. If you think about productivity and product development and customer service, customer support, go-to-market, all those dynamics, we're seeing massive productivity. We are built for growth as a firm. We're going to continue to grow. What's interesting is as you grow, you can actually grow without adding as many people, which is the way you actually have to think about this. Now, in certain instances, there are going to be certain categories of jobs that become very much affected by artificial intelligence and Gen AI. Other categories become very much more enabled by that. And so it's a balance of expression and expansion as you get these systems to actually operate at scale with capacity. And part of what we've been leaning forward in doing with all of our portfolio companies is we've built out now an agentic factory. We have some fantastic partners. We're now able to take the architecture of these workflow systems called enterprise software, the unique data sets, which less than 1% of the data in enterprises actually exist in these foundational models, and actually create agentic solutions that create highly efficient dynamics in operating through these existing workflows. That's a unique aspect that enterprise software companies can actually embrace. The value of incumbency is really going to matter in certain of these industries. So that productivity will actually absolutely make its way through the overall economy and, of course, private equity firms ultimately.
Right.
We have unique workflows in private equity firms that we can actually leverage these solutions.
Okay, so what did that story get wrong then? I mean, because all of that would indicate that you're pushing towards a leaner workforce potentially, or as you say, maybe deployed in different ways.
Yeah.
So what did it get wrong?
We are not reducing our staff by 30% or whatever the number was. I don't know where they got that from.
Are you planning to slow hiring as a result of all of
in certain
this?
areas, yeah, for sure. But when I look at the work that we do in our private equity business, our credit business, our value creation business, massive amount of opportunity. And here's why. If you think about the waves of how technology have played out in over decades, the first wave, of course, is typically I call it the hardware providers capture the vast majority of the economic benefit. Second wave typically are what I call the service providers, infrastructure providers, in this case, hyperscalers capture that benefit. And you're seeing that play out. It is the enterprise software vendors ultimately that, if you have, I call it sovereignty and dominion over workflows and data sets, that have the ability to take this agentic solution sets and capture massive amounts of economic rent opportunities. It expands their TAM dramatically. One of our first companies that went through our AI factory, our agentic factory, it now has expanded a market now 10x what they had before. Now, the way I like to say it, Gen AI will enable enterprise software to eat services. Okay, it will create a massive amount of efficiency in the work that it does in workflows, and we are now installing these systems real time across literally hundreds of customers, and it's non-trivial work. But as you do the installations, we're actually starting to see the benefits of it. Of course, we're taking those same sort of systems, and we have been within Vista and saying, okay, what are the areas within a private equity firm that we can leverage so that our people can become more productive, they can expand their area of their TAM of opportunity. And the good news is the enterprise software market right now has a disproportionate valuation relative to, call it, the AI groups. That as you make these agentic and AI enabled, I think these businesses are going to create massive upside and opportunity for our investors. That's what we're focused on.
So there's so many threads to pull on in there. I guess I'll start with the valuation question first. Do you think that publicly traded AI is in a bubble?
So it's an interesting question in that, you have to build out infrastructure. And again, being a student of history around as an investor, you have to be. It took massive amounts of capital to build out the infrastructure that we benefit from now. You remember the global crossings of the world, building out cable and fiber. And now some of those companies went bust. It was in a bubble. Some of those companies ended up being the winners because they built at the right time, right capacity, and the needs and demands of what the market.
Although in some cases they took
demand of
decades to come back
in some cases.
Stock prices.
Absolutely. So those are the dynamics. Everyone we're putting trillions of dollars into an infrastructure that is a question of, do you have enough power to support it? And you argue, is there a bubble because you can't support it with the power? There's an argument around that. Are there enough component parts? Is there enough distribution? Are those component parts that we are looking at today going to actually give the power demands that are required? We're hearing, of course, there are other solution sets that have lower power by a tenth of what we're seeing. So do you need the same sort of power? So all of those are market dynamics that have to reach certain points of equilibrium over time. Where we focus, again, all of that provides infrastructure for enterprise software. At the end of the day, what we're going to be doing is utilizing inference. You can put it in the form of tokens, utilizing inference to create massive economic rent and productivity for our customers. That will all inure to the benefit of those enterprise software vendors who become agentic. So there's going to be ebbs and flows over who is actually capturing what value at what period of time. Certain folks will have monopolistic positions for short periods of time, and then others will come up with, like an all silicon, different solution sets that will be lower cost, suit to purpose, different infrastructure. Do you have to have it all centralized? Can you do it at the edge? In terms of the inference capabilities, do you need 1 gigawatt power supply, or do you need 50 megawatt to do certain inference for certain use case applications? And is that more suitable for that use case application? So we're going to go through those waves, and some parts of this market are in bubbles, and other parts are very much in a great investable space.
Coming up, we're looking at some of today's trending tickers. Stay tuned, you're watching Market Catalysts. Now time for some of today's trending tickers. We're watching Palo Alto Networks, Cipher, and ByteDance. First up, Palo Alto Networks, the cybersecurity firm out with earnings that topped Wall Street estimates. However, the stock is under pressure. The company did announce it's buying cloud observability platform Chronosphere for $3.3 billion. The deal aimed at boosting its AI-enabled cybersecurity offerings. Chronosphere helps customers wade through huge volumes of information to reduce data complexity and try to optimize costs. The acquisition comes on the heels of Palo Alto's move to buy CyberArk software as well. Next up is Cipher, the crypto miner looking to raise more cash in the high-yield bond market, according to Bloomberg. The company already raised more than $1 billion as it looks to build out a data center linked to Alphabet's Google. Debt deals tied to the artificial intelligence boom have flooded the market in recent weeks. The company also just signed a 10-year high-performance computing deal with FluidStack, an AI cloud platform. And ByteDance, the parent company of TikTok, saw its valuation soar to $480 billion. Chinese investment firm Capital today bought a block of its shares at the nearly $500 billion valuation, according to Bloomberg. It's a positive sign for the company, which has been forced to sell its U.S. operations. The current deal under discussion would avoid the most damaging outcome. ByteDance will likely get about half of the profit from the platform's U.S. operations, even after it sells a majority stake to American investors. Well, coming up next, we will be getting you much more markets coverage. You're watching Market Catalysts, and we'll also hear from Robinhood co-founder and CEO Vlad Tenev. As part of Yahoo Finance Invest, Brian Sozzi spoke to Robinhood co-founder and CEO Vlad Tenev to discuss the power of the retail investor and the company's new cash delivery service.
We're launching a service, Robinhood Banking. It's rolling out to external customers right now. Early feedback seems quite good. And the idea is, can we actually give you the private banking experience? So the same type of experience that a high net worth individual would get from a private bank, but with the digital experience they've come to expect from Robinhood. And as we started thinking about the types of features and services that the high net worth individuals would get, one of them is they're not going to an inner city ATM. They're getting cash delivered to their house. And surprisingly, even though we're getting increasingly digitized, cash is still a very important part of the US economy. And people need it from time to time. And when they need it, we want to deliver it to them with the convenience they expect from other digital services. So high net worth individual gets cash delivered to their house in a truck. We figured out how to do that in partnership with GoPuff to the mass market.
Vlad, how does this?
And that's just one of many features that I think make Robinhood Banking the best solution for customers.
Vlad, how does this come? Look, I have full disclosure. I've not used this yet, but I'm curious about it. How does this cash come? Is it in a bag with a dollar sign on it? Like, how's it packaged? I've never had cash delivered to my house. Is what I'm trying to say.
Yeah, we don't want to just deliver it to you in a shiny bag with a dollar sign. I think it's a little bit more discreet than that. Gotcha. But actually, one of the initial markets is New York, so I encourage you to give it a try.
Fair enough. Look, one of the benefits of doing an event like this, we can actually get in depth into your story, the story of Robinhood. Take me back to the 1997 Infiniti Q45, Vlad.
Well, that was a very nice car. It was a boat of a car. That's a deep cut. So I was a graduate student at UCLA, and my co-founder, Beju, and I put all of our belongings, including some servers, into the back of my Infiniti Q45. We couldn't afford to move with movers, and also plane tickets were quite difficult. So we drove across the country to where you're sitting now, New York City, and started our first company. This was a high-frequency trading firm in the absolute middle of the global financial crisis, where everyone was telling us that was the worst time that you could possibly start not just a any company, but a financial services company. But the industry changed. There was a lot of disruption. Institutional finance went from kind of open outcry trading on the floor to completely digital. And then this sort of like set the seeds for us launching Robinhood many years later, where we basically combined the technology of high frequency trading with the new platform shift of mobile and became the first mobile first zero commission financial company.
Do you still have the car? It's a bit of a historic thing, almost like the IBM Garage or whatever that was?
No, unfortunately, I don't have the car. It stopped running right around 2013, and then I sold it for about $300. So someone got a great deal in Northern Virginia.
Vlad, one thing inherent to your story, and you and I have talked about this a lot the past 18 months, but really this year it is the product velocity over at Robinhood. It seems like every day I wake up, there's something new coming from you and your team. Help us understand how you're able to get some of these products to market so quick, and how are you identifying new areas to grow in the space?
Yeah, I think that we've been fortunate to have spent a lot of time over the past few years building great infrastructure, both on the technology side, but also great people, great leaders. And we try to move fast and do so safely, because we recognize we're a financial company, and you want to make sure that customers have a reliable service. But I think we've been able to move fast while making sure that we do so safely, and it just requires having the right talent and the right technology infrastructure, which we continue to invest in. And it's not always the sexiest thing to talk about, but there were a couple of years, 2020 and 2021, where we didn't ship too many products, but instead we really got our house in order and built the foundations for the company you see today.
What's been the biggest game-changing product for Robinhood this year?
Well, I'd say the last quarter we announced that we had record net deposits, so 20 plus billion in net deposits in the quarter into the platform. And we already surpassed last year's record of net deposits with another entire quarter to go. We also announced 11 business lines, up from 9, that generate 100 million plus in annualized revenue run rate. The two new ones are Bitstamp, which is our institutional crypto exchange that crossed into the 9-figure revenue run rate, and also prediction markets. Prediction markets, which we've talked about, our fastest growing business of all time from a revenue standpoint, doubling quarter after quarter. And we also announced so far in October, we've traded more contracts at about 2.5 billion than all of Q3 put together. So that's been ramping extremely quickly. So I think I'd have to point to that one as the fastest growing. That's on the active trader side. But again, you look on the wealth building side, where we're not just building for active traders, but we want to be your primary financial account and your secondary financial account. You mentioned financial super app. Banking's looking really good. Credit card has ramped to north of 500,000 cardholders incredibly quickly, which makes us one of the fastest growing in that space. And Robinhood strategies in retirement have been ramping as well. So I'm proud of how the team's been able to build for these very different customer bases, active traders on one hand, but also becoming the platform that can help all of our customers, the mass market, with the totality of their financial needs.
Vlad, here's what Bernstein just said about Robinhood after your quarter. Quote, quarter after quarter, Robinhood management raises the bar and tells us why the stock deserves its valuation. How do you model a company that adds a couple $100 million revenue businesses every year? How could an investor model a business like yours?
Well, I think that we try to give our investors really leading visibility into how things are evolving. And as you could probably tell, even the way we're communicating with investors is evolving and improving. So it was less than a year ago that we did our first video earnings call, for instance. And we've improved upon that experience. The last earnings call was not only on video, but we had live video question asking from retail customers. We had sell side, buy side, and the media in the room. And it was in the Chase Center in San Francisco. So we actually did it at a interesting location. So the communication with investors, I think, has been improving, and it's a product in and of itself. In terms of the financial profile of the company, we keep it very simple. We want to grow revenues faster than costs. It sounds simple, but it's actually not trivial to do, especially at high scale. And we make big bets. You know, we're not only content to improve the products we have incrementally and get a little bit better, even though that's very important, but we also make bets on new categories that you don't see elsewhere. And that led to innovations that are relatively unique to Robinhood in our space. For example, 24-hour markets on the active trading side, cash delivery, which you mentioned on the banking side, the deposit match products, which still continue to be unique, and of course, prediction markets as well.
With Walmart stock popping after its strong earnings report, we'll take the pulse of the broader retail sector. That's next on Market Catalysts. Walmart shares are rising after the retail giant reported strong third quarter sales and raised its full year outlook. Let's bring in Corey Tarlow, Jefferies Senior Vice President of Equity Research. Corey, it's good to see you. Brian Sozzi and I just had a chat with John David Rainey, the Walmart CFO, and he pointed out what we've all been talking about, of course, which is that upper, middle, and upper income consumers are doing a lot better than lower income consumers. But it sounds like all of them are going to Walmart. And so I just wonder the read through from Walmart and that, income disparity and spending disparity and how that feeds through to the overall retail sector.
Yeah, it's a great comment. And it's definitely something that I think resonates at a time when, you've definitely seen some pullback at the low income side of the income spectrum. And I don't think that we want to sound any alarms on the lower income consumer, because overall the trends have been consistent. I mean, we saw the jobs data today. I think that what you're seeing as a result of fear around maybe the SNAP cuts, I mean, this is a real dynamic that a number of Americans are grappling with at the moment. But what you're seeing is that they're leaning on Walmart even more. And I think that came through this quarter. It came through in the outlook. And you have a company in Walmart that is where the story is clear. You have scale plus technology, and that equals resilience. And you're seeing it in the stock today.
And so you're seeing it in the stock today. Do you think that Walmart is one of those that, if things improve, if things get worse, will Walmart be sort of well positioned regardless?
Yeah, I think that the narrative for Walmart is one where if it rains on everybody else, maybe it only drizzles on Walmart, because they are very defensive in terms of the prices that they offer for the quality of the items for those prices. And if you combine that with the convenience, you just have a really nice combination. And by the end of this year, they're going to be delivering to 95% of the US in under 3 hours. A number of their e-commerce orders are now expedited. You're seeing really strong growth within the e-commerce side of the channel, really strong growth in the stores. And all of this is just creating an ecosystem where Walmart continues to win. And you have higher income consumers, like you mentioned, Julie, that are coming to Walmart, and maybe they're going for something in the pharmacy, like GLP-1s as an example, which has been a really substantial tailwind for Walmart's business. And then they stay for the value and the food and the general merchandise that they're offering. Apparel, for example, is now up 5%. That's really, really strong for the company. Their general merchandise business has been, at least in this specific quarter in the U.S., the best in years, I think. I just got off the phone with the CFO of Walmart U.S. and sounded very, very encouraged about the U.S. business and the general merchandise side of the business. And this all kind of points to that flywheel effect and helping to build membership and recurring revenue and ultimately more visits, more sales, more profit for Walmart.
Corey, so if we broaden it out and we talk about what the consumer is looking for right now, talk to me about cheap versus value, right? Because I think like value is the buzzword that everybody's talking about right now, but I don't think most of the time you mean just cheap when we're talking about value. And so beyond Walmart, what does value mean and who is offering it and appealing to the consumer?
Yeah, it's a great question, and it's really pivotal in times like today where you have inflation data that continues to run fairly tame but elevated versus historical precedents. And I think that you see revolving credit usage continue to be strong. So there's definitely a focus on value, to your point. And the way that we sort of contextualize this word versus cheap is that value is about the quality of an item for the price that you get it at. And there are a few key retailers where that's really resonating and clicking right now. Obviously, you're seeing it in Walmart's print today. You're seeing it in Costco's numbers. You're seeing it you should see it, in Ross stores, which prints this evening. And then I also think Gap is another one where Old Navy is being overlooked as well. So those are four kind of key retailers that we look at when you think of the value versus cheap, where I think it really resonates with consumers globally today.
And Corey, you've been a defender of Target, but it's been tough to be a defender of Target. And this quarter it was tough again to be a defender of Target. Where is your optimism coming from on that one?
I'll keep the pitch quick, but you are right. I am one of the few buy-rated analysts on this one and still continue to be. And it really comes down to change. And that was a word that was used significantly on the earnings call yesterday. And I'm hoping that resonated with the investment community and with the population. It's that Target is going to change. They are investing in change. They just raised their CapEx by 25%. They're investing in an American business. It's now $5 billion of investment that they're going to be making next year, up from $4 billion this year. So it's very clear that they're investing in growing the business. They're going to invest in their people. They're going to invest in their properties. They're going to invest in their products. And that should all help to change the consumer experience, the perception around Target, not to mention they're lapping the easiest compares in retail, or among the easiest compares in retail in 2026. There's margin upside potential, given margins have been on the decline for a number of years. And then valuation is finally very undemanding at around 11 times earnings versus something that's been in the mid to high teens for a number of years.
It is. We'll see if your faith is rewarded eventually, Corey. Thanks a lot for joining us. Good to see you.
Thanks.
Coming up, full market coverage ahead in the second hour of Market Catalysts. Minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here. We do have a rally going on across the board. A little bit off the highs of the session, but nonetheless, the Nasdaq is still up by nearly 2%. The S&P up by nearly 1.5%. The Dow up by about 1.25%, and it's a broad-based rally as well. We've got the communication services group doing the best today, but all of the sectors in the S&P 500 are in the green. Comm services is followed by information technology, consumer discretionary, and energy. Obviously, we've got a number of different things contributing to gains today, including the jobs report, Walmart, and Nvidia. Let's dive into the jobs report in the markets a little bit more now. The U.S. economy did add 119,000 jobs in September. That was well above estimates. However, the unemployment rate did edge up to 4.4%. So the numbers didn't really conclusively settle the debate about whether the Federal Reserve will cut rates in December, especially since it's the last jobs report before the next Fed meeting. Joining me now, Rayanne Mitrione, Callan Family Office market strategist and founding partner, and John Hilsenrath, StoneX senior advisor and Yahoo Finance contributor. Rayanne, I want to start with you and this jobs report because, again, the non-farm payrolls number looks strong, but there was a drop in jobs in August, and then you have the unemployment rate ticking up. So what does it tell us about the Fed?
It is certainly presenting a mixed picture, and you have to take into account that this is a lagged data that we're looking at September here. But we are seeing, this was much stronger than expected from a payrolls perspective, but we did see the unemployment rate tick up. I mean, overall, the market is viewing this as positive, but it probably does mean a December rate cut is less likely.
John, is this good news for the market? That would be unusual.
Good news is good news. Yeah, I think that whole correlation between bad news and good news has changed over the last few years. And in this case, yeah, I think it's generally good news. The job market isn't sinking. I mean, there certainly is slack, as we see in the unemployment rate rising. But I think the Fed gets a little bit of relief that there's not something building that they have to move quickly to act on. And I agree. I don't think, I mean, I've been saying for months, I didn't think that December was a smart thing to do. And it looks like the Fed has figured that out. Like, why rush when they're in this data fog? If we get subsequent data, if it suggests that they need to cut rates, they can do it in January. They don't have to do a hurry and do it in December. So I think that's probably where they're going to land in the end.
Well, I rush because the market wants them to rush, John. No, I kid. But I mean, it's interesting because Beth Hammack, who is on the Fed, although an alternate voting member until next year, I believe, she's out again this morning in a speech reiterating her concerns about inflation. And John, I know you share some of those concerns, but there also is that vocal contingent that says the job market is worse than these lagging numbers would indicate.
Yeah. Well, the trade-offs are not easy for the Fed right now because, as you say, inflation is above their 2% target. And as the minutes that the Fed came out with showed, a number of people are concerned that not only is it above the target, but the progress that they were making in 2024 stalled in 2025. And at the same time, the unemployment rate is rising. The Fed projected a 4.5% unemployment rate for the end of the year. What we learned today is that it was at 4.44% in September. So it was only a few hundredths of a point away from where the Fed thought it was going to be the end of the year. So it's hard trade-offs, but I think the important thing is we don't see a lot of momentum in terms of the economy sinking in ways like we do during a recession where it's feeding on itself. We see this kind of stagnation in growth, kind of like a stagflationary story that we've been talking about, that they want to address it, but they don't necessarily have to hurry to do it because there's a worry that it's going to feed on itself and build momentum going into 2026.
Well, and Rayanne, when you look at corporate earnings, right, there you don't necessarily see that stagflationary backdrop, right? You look at, I mean, just in the past 24 hours, you look at Nvidia, you look at Walmart. Nvidia in particular seems to be pushing back against all of this AI skepticism.
Yeah, I mean, if the expectations were really high for Nvidia and they exceeded expectations in every way, and we've seen that throughout earnings season, that it's been really strong. We're basically at the end now, and we're looking at the fourth straight quarter of double-digit earnings growth and profit margins that are the highest that we've seen in the last 15 years. And it's so we definitely are seeing that strength in the economy. And that's been a positive for stocks broadly, and the AI tailwind on top of all that has just made this an incredible environment.
So what does that do for your investing strategy or how you're thinking about it?
I mean, certainly want to maintain risk in portfolios. I mean, with the strength of the economy, with the resilience of the consumer, with corporate strength, more or less a dovish Fed now. All of those are positives for the markets. So we want to maintain our equity exposure. We do want to be diversified. We don't want to be all in exposed to anything AI related. We want to have value, small cap, international, and other asset classes to round out those exposures. But we are pretty positive for the period going forward.
And John, just quickly, how much does the Federal Reserve pay attention to the corporate earnings as an economic indicator?
I mean, I think it's a background secondary factor. And here's where I think it matters and that the Fed is going to have to process. Margins are very high. Corporate margins are very high. And I think what you see from a lot of executives right now is they want to protect those margins. And what you also see is there's been a lot of investment in technology. And I think the story in 2026 becomes business protecting margins by trimming their labor costs. by reaping the gains, the benefits of this technological investment by cutting labor where they can. And this causes a challenge for the Fed because, and it might lead to a more dovish Fed, because on the one hand, it softens the labor market. It might push the unemployment rate a little higher. It also takes some pressure off of wages and wage pressure. So maybe it relieves a little bit of the inflation pressure that we've seen over the last few years. And we're going to have this balancing act between productivity gains on the one hand, but also, tariff price pressures on the other. And a sustained problem, I think, that the Fed is going to have to be watching on the labor side of the economy, because companies want to protect their margins by trimming their labor costs. And that, I think, is a big story in 2026.
Yeah, maybe good for investors, not so good for the labor market and for the economy.
Yep.
Rand, I want to end
That's
with
the
you.
K-shaped economy, by the way.
Yeah.
That's the core of the K-shaped economy.
Yeah, we've already been seeing it and feeling it, obviously. Rand, I'm curious, finally, outside of AI, where you're seeing some good opportunities right now.
Yeah, I mean, obviously AI has been a great place to be, but we do want to have some other exposures. Investing in private markets has been a good complement, whether it's hedge funds, credit-oriented hedge funds, private equity, private credit, private real estate, but also within equities, just having that international exposure. I mean, even with all the movement in AI, we've still seen international developed markets up 24% this year on the weaker dollar primarily, but that's been a great place to be. So we want to have exposures there on the value side, small cap, just kind of round it out.
Yeah, good reminder about international markets. Rand, John, thank you so much. Appreciate it.
Thank you.
Thank you.
Coming up, Jared Blikre will be here with Stocks in Translation and tell us why global stocks, are trouncing the U.S. It's almost like we planned it. You're watching Market Catalysts.
U.S. stocks are in rally mode once again, but the nation with the world's biggest stocks like Nvidia, Apple, Tesla is getting trounced by countries around the world with much smaller markets. And on today's Stocks in Translation, we're going to take a look at some of the best performing countries in the world and, importantly, see if they're still a good buy or if it's simply too late to jump into international waters. Now, it's a remarkable story, especially considering the new tariff regime that was unexpectedly thrust on the world earlier this year. And we recently talked to Editor-in-Chief of Investopedia, Caleb Silver, about some of the amazing gains around the world. Here's what he had to say.
What's crazy is that these markets have been strong all year despite tariffs.
Yeah.
Now, China is also outperforming the U.S. despite all the threats of tariffs. But even if you look at countries like Poland and Greece, they are trouncing the United States. Not big stock markets, not very liquid, and don't really hold a lot of growth stocks, but they've sort of been immune to a lot of the political and trade and tariff noise that's been out there.
Now let's take a look at the U.S. and some of the big winners around the world. This is the heat map of country ETFs, and it's just a sampling. All returns are year to date. In the bottom right here, we have SPY, SPY. That tracks the S&P 500, which represents the U.S. And it was not hard to find 20 countries which are handily beating the U.S. You can see in the upper left, that's Korea. It is heavily levered to the tech trade and chip stocks, so not surprising to see it's winning out here. And check out number 2, it is Greece, up 65%, rising from the ashes of the global financial crisis. And Greek is not even a story about AI or tech, it's about fiscal discipline. And we don't have time to dig into each one of these, but just to let you know who else is on the top row here, EWP is Spain, then EPOL is Poland, both of those up over 60%. Then there's Peru, Vietnam, and Austria to round out that top row. But investors want to know, have these foreign markets gone too far, too fast? Is it too late to jump in? We asked Caleb that very question. Here's what he said.
It is very rare, though, to see international markets outperform the U.S. for an extended period of time. It's very much a U.S. stock market around the world. No, not being nationalistic here, it's just the biggest market and the most liquid in the world. So this is very rare and it doesn't last forever. I wouldn't say it's too late, but I wouldn't go all in or even load up half of the boat with international stocks at this point.
So if you're sitting on some nice gains, you might want to lock in some profits depending on how much exposure you've got. And if it's a small amount, then maybe you just let the investments ride. But if you're thinking about jumping in, you probably don't want to make these a huge part of your portfolio. And it's also helpful to look at how this basket of country ETFs has performed recently. So in the fourth quarter, since October 1st, here we see a different picture. Chile, or ECH, tops the list, up about 14%. And then there's Korea again in the number 2 slot, up 11. Brazil is in third place at 6 to 7%. Then Spain, Poland, and Hong Kong are each up about 2% or less. The biggest loser in the fourth quarter is China. It is down by 7%, followed by Germany and then the Netherlands. And you might be thinking, wow, there are really a lot of tickers here and choices. So where do I begin? Caleb feels you, so let's listen to what he had to say.
But you don't have to go out and look at the map and go put pins in them and try to pick them individually. Buy the MSCI All World Index. Make it a part of your portfolio.
So picking individual countries can be difficult, and maybe as difficult as picking stocks. So that's why he's recommending a much broader approach. And here are a few options right here. You can invest in an ETF that tracks the entire world ex-US, which includes no US stocks. That's what ACWX is showing right here, up about 25%. You're not getting the eye-watering returns of South Korea, but you do have a little bit less volatility. And if you're only interested in developed countries or emerging markets, you've got some options there too. SPDW, that contains all the stocks in the developed world except the US. And EEM is one of the oldest emerging market ETFs. But be careful, as it's weighted very heavily to China, as are many emerging market ETFs. So if you don't want China, but you do want EM, you can go with EMXC for that route. Now, all of these options happen to be up over 25%, which is still double the US. Now, finally, here is a checklist of things that you might want to consider before jumping in or even just kind of reviewing your trades. Number one, do tariff headlines still get ignored? That's a big one. Then, are US mega caps regaining momentum? And then, are you overloading one country or theme? And finally, how's the US dollar doing? Is it weak or is it getting stronger? Tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance.
We've heard from multiple retailers in recent days, from Walmart to Target, that stretched consumers are on the lookout for value and deals. Sally Beauty, which operates over 4,000 stores for professional and everyday consumers, says spending is holding up in the beauty industry. The retailer beat Wall Street estimates in the latest quarter and expects sales to rise as much as 1% in the next quarter and coming fiscal year. It's also planning expansion into fragrances, spa, and skincare products. Denise Polanis, Sally Beauty CEO, is joining me now. Denise, thanks for being here.
For having me.
So talk to me about the beauty industry. I mean, against this backdrop of consumers really driving for value and the sort of K-shaped economy that we've been talking a lot about, how is that playing out for you?
You know, I think, first of all, beauty is a very resilient space overall. You know, when you look good and feel good, then everything else kind of falls in line. You know, what we've been seeing is, as you mentioned, a resilient consumer, but one who's being pretty choiceful and one who's leaning into DIY and getting as much value as they can out of that.
Denise, help us understand your consumer, right? Because we've got the Ulta Beauties and Sephora's of the world, but we also have growing beauty businesses at places like Walmart. So where does Sally fit in, and who are the customers who are coming to your stores?
We serve two different customer bases. The first is the regular retail consumer. It does skew lower income, so middle to lower income is the dominant proportion of that. And then we serve the pro stylist community, where their end customer is usually the higher end customer coming in for kind of full salon treatments. So we span both edges of that economy. We certainly see, the Sally Beauty customer being a bit more pressured than we see that high income customer who might be going to salons.
And Denise, I'm sure you're familiar with the so-called lipstick effect or lipstick index or whatever people want to call it. The idea that even if people feel economically challenged, they're willing to spend on sort of little luxuries like a lipstick that still makes them feel pretty for not, a lot of bang for their buck, I guess you could put it. Is that still hold true? Is that something that you're seeing?
It does still hold true. And where we see people leaning in is where they can get great results for great value. So where they can find a fragrance at a sharp price point that gives them that experience they want. Where on the hair color side, they can color at home with a pro quality product and color their hair for $25, much less expensive than a salon, but leaning into that support or that impulse where you say, I really want a treatment for my hair. It's not feeling great. I might lean into that serum or that mask to be able to keep that shopping experience. But be aware of their total pocketbook.
And when you talk about coloring at home, I was surprised you guys talked about some survey work that you did about people coloring their hair at home. What did you find?
What's amazing is this DIY concept and how customers today don't think there's only a one-size-fits-all solution. So when we did some survey work, about 61% of people that we surveyed say, I do color my hair. What was really interesting to us is out of that population, about 40% of that population said, I only color at home. About 20% of that population said, I only color in a salon. And what we're really interested in is that middle 40% say, I do both. I might go to the salon to get the look I love, and in between salon visits, I'll do my own touch-up of color. And how you can become confident in doing that is a core part of our offering.
And Denise, whether we're talking about hair color or some of your other products, how are you guys thinking about pricing right now, which is so key in this environment? Have you been able to raise prices this year? What are you planning for next year? Or do you feel like you don't have that flexibility because of where the consumer is right now?
Yeah, I think the great position that we're in right now is we haven't needed to raise prices very much over the last year. So 80% of our product comes out of North America, so limited exposure to the tariff environment overall, which we are pleased to be able to sit in that position. Our customers tell us what they like about us is that we just offer things at a core value. So on our customer kind of retail side of the business, 35% of the business is our own brands, which by themselves are luxury product at a great value price. Think $10, $12, $14, things that are pretty accessible to folks. So we take small incremental pricing when we need to, but we're pleased this year that we haven't needed to lean in some places where some others might have.
And then we mentioned that you guys are expanding into other types of products, skincare products, spa products. What does that entail and what's driving that decision?
I think there's two sides of that. One, on the Sally and the retail side, we really are looking to modernize, and where we've been more of a utilitarian beauty supply shop, we're really leaning into being a specialty retailer. And with that, we're creating a new modern experience in our stores, light and airy and bright. And what our customers tell us is we have permission to expand beyond hair into other things that can get them excited that uniquely follow our same value proposition. So that could be leaning further into nail, leaning into eyelashes, leaning into fragrance. For us, it's about finding those right items that fit a great price point that we're excited about. And on our pro side with our stylists, that a stylist community is also a very aggressive beauty community in and of themselves. And so our ability to expand beyond a hairstylist into estheticians and the skin and spa space, we see as a nice future potential to really build upon our capabilities as a high quality wholesaler.
And Denise, just quickly as well, what about the cadence of store openings? What are you planning on that front?
All in all, we have about a flat store count. So we've got 4,500 stores globally. We think that's a healthy place to be. What we're really focused on doing is remodeling part of our fleet. And so in Sally US, we've updated 50 stores to our new concept. Right now, by the end of fiscal 26, we will have close to 100 stores in this new format. And we want to keep going on that to really modernize the experience and balance it out with our omni-channel offering. So we continue to grow on the omni front as well. Our Sally US Canada Omni side of the house was up 35% this past quarter, which we're also really excited about.
Denise, thank you so much for joining us. Appreciate it.
Thanks for having me.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We've got more Yahoo Finance ahead, including a special look at our interview with Strategy Executive Chairman Michael Saylor from Yahoo Finance Invest.